Sub the 19,300 mark, just about skirting around that level. 19,289 is the first print on the index, and that's a significant downside now of 80 points. So 19,282 is where we're currently at. The breadth of the market, though, surprisingly, although it's early minutes still, but that once again has started off on the NSE well in favor of the advances. It's a 2:1 ratio that we continue to maintain. The Nifty Bank, much in sync with the Nifty, 0.4% lower right now. Let's see what IT, metals, oil and gas, what are these sectors up to? Because you can see a lot of red on the screen right now. IT, of course, has taken a sharper knock today. Metals still relatively okay, flat for the Nifty Metal Index as of now. The oil and gas sector as well should come up for you on your screens next. I want to see what OMCs are up to. Remember, there's talk of an excise duty cut. So let's see what OMCs, what some of the city gas distribution names are up to. They will just come up for you on your screens. And you can see a little bit of red coming in there. Pretty much part of what the rest of the market is doing. What are the Adani names doing? Let's see what the liquid names are up to, because that will typically give you a flavor of which way the market could be headed today. Remember, Adani Power, newspaper reports are indicating that actually Abu Dhabi National Energy Company and PJSC may be acquiring a stake in the company. That is what newspaper reports seem to be indicating. Adani Enterprises as well. The arm Mundra Solar Energy has got a COD certificate for a solar PV manufacturing plant. So some of these names are managing to still hold out. Bata, very important clarification. They're saying about all the buzz around their tie-up with Adidas that they continue to explore strategic partnerships. So not really confirming or denying. Let's see whether there's any follow-through in Bata. No, it's down about 0.6% right now. There's also, a couple of other names. South Indian Bank. The RBI has now given a nod to appoint PR Seshadri as the MD and CEO. A big gap up move on South Indian Bank, holding up 6% as we speak right now. So these are a bunch of stocks which are in focus. Also, let's revisit some of the buzzers from yesterday. And REC, PFC, remember, have been doing very well. Some of the mid-cap IT names held out in trade yesterday. Case in point being a Birlasoft, Coforge, etc. But that pack is not really seeing a follow-through. Ajay, what are you spotting?
I'm spotting a very big block deal which has just happened on GMM Pfaudler. GMM Pfaudler, almost 13% stake has exchanged hands in a block. The stock is lower by 10% first and then another 5% now. What is important is that GMM Pfaudler actually is a capital good company for the chemical space, which is quite bombed out. And this quarter, the numbers were pretty okay after a very long haul, and the results were pretty decent. So after this appears to be institutional action which has happened. We'll try and find out more on that. And also Manappuram. Manappuram has also seen a block. Some of the chemical names are actually witnessing buying from last 2-3 days. Yes, despite all the bad news. Look at Balaji Amines, SRF and Gujarat Fluoro. All of them have actually opened in the green and are gaining in trade along with Divi's. Yesterday, Gland had a great day. Follow-up buying is not coming, but after yesterday's 6% move, it will be interesting to watch out for. Gland another 1% right now. Avan, what are you looking at?
Okay, yes indeed. Yeah, those are some of the movers. And if we're just checking in as to what the action is within the mid and the small caps, today you're not seeing that degree of outperformance, Ajay. The fact that it is pretty much neck to neck with the frontliners, small cap index trying it to eke out again, but not pretty evident. Let's find out the first trades from our chartists then. And Kunal, just looking at the screen right now, holding on to 19,300 by the skin of our teeth at that. What's your first trade?
Yeah, I think we will still wait out for that confirmation of 9300 on the index to go short or whether to change views. On the stock specific front, Manappuram Finance is something which looks attractive. The stock has actually come back to that 150 odd mark, 149, 150 level. So this could probably be attractive territory to go for a contra buy as well as a build up of long for Manappuram Finance.
Right. Naresh, what are the first trades that you're punching? To unmute yourself.
Getting into Federal Bank, that's a stock which looks interesting and would be looking to add it up more on a move above 136, 138 levels.
Okay, that's the take coming in on some of the first trades coming in from both Kunal as well as Naresh. I'm just going to refresh my screen and tell you what the F&O markets as well are pricing in. The first trades are yet to trickle in right now. But in the meantime, let's hear out Nilesh Shah from Envision Capital. He's actually saying that even in this market, there are several opportunities in the broader markets which he continues to spot. He recently invested in MapMy India and owns a bunch of other stocks as well. Let's hear out his top picks in the portfolio.
We've moved on into the world of the power of products.
Okay.
Where a lot of the SaaS-oriented companies are companies which are very focused on specialized areas. You could be a SaaS provider in the travel hospitality vertical, or you could be a SaaS or a products company in banking, financial services. I think it's important to look at that part. It's great to look at, I think, some of the platform companies who are using technology to grow, or look for companies which are deep tech companies.
What is deep tech?
I think where you have developed so many strong competencies which are very hard for anybody else to create and have a very wide-ranging applications.
Which company qualifies the cut?
So currently one company that we've just recently invested in, we own it, is essentially MapMy India C Infosystems, which went public I think a year and a half back.
But they've had a volatile delivery record.
Not really. And that's always a challenge, that a service company can deliver to you quarter-on-quarter performance.
Yes.
But a product company may not be able to deliver you quarter-on-quarter performance.
We're not used to tracking it that way, so markets they tend to get nervous.
Correct. So you have to, I think we all have to come to reality that IT services is one thing and products, SaaS and deep tech is another thing.
But globally, Nilesh, SaaS companies have also come down. A clear example is Farmworks, Freshworks, I beg your pardon, thank you.
Yeah.
It had a great listing. SaaS, the first Indian SaaS company to go public, and then it's down, it's struggling, it is not reporting great numbers.
Yes.
So while SaaS is a great idea, but theoretically, globally, SaaS companies are not doing well. And I've seen globally what happens normally adopts here.
The challenge with those companies is that they still don't make money.
Yeah.
They still have losses. Some of them have accounting losses because of high ESOP provisioning, but otherwise they don't have clear demonstrable earnings to showcase. And public markets are always about earnings and cash flows. No matter what you grow, but earnings and cash flows matter the most. Fortunately, in India, we have some of the companies in this bucket which have relatively more consistent growth. They may not have the hyper growth, but they still have growth. And
all right, let's take the discussion on markets forward with Pankaj Chibriwal of Kotak KMC also joining us now. Pankaj, morning. Thanks for making it finally to the show. We were looking forward. Given that there is so much of talk around mid-caps, we are witnessing very specific flows into mid-caps, even by your FII brethren as well. And there is outperformance there. So are you finding it challenging to look for or identify mid-cap ideas which are still not very heavily or highly priced and are attractive in your risk-reward gauge?
Hi, Ajay. I think being a practitioner in this space for more than 15 years now, we have seen cycles playing out in this space. And in the near term, our view is that one needs to be a little cautious on this mid and small cap space after the run-up which we have seen. And there are 3 or 4 data points which we want to share with you, which is giving us that some sense of cautiousness in the near term. Though we all are believers that this is a wealth-creating space, and if you are patient enough, disciplined enough, over a 5-year, 10-year cycle, this space tends to be generally very good from an investor return perspective. But in the near term, there are some dark clouds which we need to be careful about. The first point, if you look at from a earnings yield perspective, which is nothing but 1 by PE, today the earnings yield of large, mid, small is virtually the same. So large caps are trading at an earnings yield of 4.5, mid caps are trading at an earnings yield of 4.8, and small caps actually are trading at an earnings yield of 4.2. And mind you, these are all profitable companies, which we are talking about removing the loss-making companies. And when you look at this matrix, it doesn't make sense to take extra risk on a mid and small cap when large caps is offering you the same earnings yield. That's the first point. The second point is when you look at the mid and small cap cohort as a percentage of total market cap, it's now at historic extremes and at about 30-31%. and large caps have come below 70%. So clearly, this points that the mid and small cap as a cohort has done extremely well, and a percentage of market cap, it is at historic extremes. So one needs to be careful about that. The third point is that the earnings yield minus bond yields in the mid cap and small cap space is almost reaching to that 2017-2018 highs. And it's about 4.5% negative earnings minus bond yield. So clearly, this is again one fundamental indicator which is pointing towards that. And last but not the least, if you look at liquidity has played a major role in terms of mid and small cap performance. So we have seen very sharp inflows into the mid and small cap funds over the last 6-8 months. In the last 3 months, 1.9 million folios have been opened in the small cap funds. And especially in the month of July, almost 0.8 million folios, new folios have been opened. So this shows that liquidity has been extremely strong in this space, whereas the free float market cap of mid and small caps have not increased to that extent as much as the shareholding which we see by FIs and domestics. So too much money chasing too little assets. So I think one needs to be little careful because cycles have become shorter and sharper, and one needs to be cognizant about that. Though from a 3, 5, 10-year perspective, if you want to express your strong top-down India view, this space you cannot ignore. But always we have seen that this space tends to be sharper while times of correction as well. I still remember 2020 March, the 3-year, 5-year and 10-year, the SIP returns in this space had become very, very inferior and people were worried. And last 3 years did magic and the entire returns are looking great. My only advice to investors will be that if you are coming in this space, come with at least 5-year view and be ready to see some volatility. Volatility in India has been at extremely low levels at about 10, 10.2, one of the lowest we have seen over last many, many years. And volatility is like a spring. If you compress it too much, it comes up very fast as well. The reason we come to know on the hindsight. So a bit of cautious in the mid and small cap space as a moment. It will be a stock pickers market. We need to be extremely careful that we don't get carried away by momentum and invest in companies where we are not, convinced about the management quality or balance sheet and cash flows, because mistakes are generally made in good times and then probably it hurts you over a period of time when you realize that. So just don't go down the quality curve. A very strong anchoring to quality bias right now and making sure you make less mistakes in this market.
That's always the aim, isn't it, Pankaj? But how is it that you ensure that right now, Pankaj? Because quality comes with a price. And we've seen that across market cap categories, the good names are expensive. So do you buy more of the same if the market does give you a decline, mid or large caps?
There are pockets of opportunity. For example, if you remember on your channel a few months back, we said pharma could be the dark horse for FY24. And clearly in the first quarter earnings, we saw pharma as a universe delivered about 24% earnings growth, almost after 6 quarters of decline in earnings. So clearly pharma saw a very sharp up move over the last couple of months. And that's was one pocket of opportunity and still remains one pocket of opportunity because valuations are reasonable out there in that sector. And we believe that over the next few quarters, earnings should be quite strong, led by the drug shortages in US and steady growth in the domestic market. BFSI also continues to be reasonable on valuation. If you look at the large private sector bank, they are not excessively expensive. There are pockets of opportunity in the BFSI space, whether it be insurance, whether it be banking, whether it be NBFCs. Industrial manufacturing continues to be a strong theme. And though in the near term, valuations have run up a bit, but if you take a 3-5 year view, I think there are many companies and subsectors within that industrial manufacturing sector which offers pockets of opportunity. IT is a tricky space. We believe that there's one more quarter of earnings downgrade cycle before IT sector kinds of bottom out. And if one is looking to invest in IT sector, it has to be from a 2025 FY25 perspective on earnings. By and large, that's our preferences, and auto anchs continues to be strong. Even in this quarter, you saw that auto anchs continue to have a very strong performance. And I think that's where our preference lies at the moment.
Okay, that's the overall sectoral theme. Pankaj, give us a view as well as to what your sense is when it comes to the liquidity situation. Given that there was a short spate of FII selling, now the buying seems to have emerged right back. Just going by the overall macro setup as well, what is it that you're anticipating on the liquidity front?
So liquidity, you have to divide it into two parts. One is the domestic liquidity, and I think there is a structural change in that. We saw it last year that the domestic, or last 2 years, in fact, in CY22 and CY21, when FI selling continued, domestics came at rescue. And I think that, buffer is now about 320 to 350,000 crores, annually speaking, which is including the SIP book at 15,000 crores per month. Then you have the insurance companies, then you have the alternates, and then you have the EPO4 money coming in. So domestically, I think we have created that strong buffer in terms of our dependence on FIs. Coming to FIs, I think our sense is that over the last 6-8 months, the interest of FIs for India has gone up materially high. We are every day meeting FIs where we haven't heard the names also, and they are doing homework for India. And largely that is to come from that incrementally they don't want to increase their exposure to China. And among all the major economies, and especially emerging market large economies, India will be the fastest growing economy, relatively speaking. So I think if you take a 3-5 year view, we are quite positive that the FI inflow into the markets will continue to be very strong. That's the reason that you are not seeing or anybody saying that markets will see a very sharp correction. At best, markets could see a consolidation phase where you could see maybe 8-10 months of consolidation, time correction, and then probably valuations and earnings again catches up together. But from a flow perspective, we are not so negative. Domestic is more structural in nature in our view. Equity cult is there. And on the FI side also, we believe the interest is extremely high. If we don't do any self-go, if we don't make any policy mistakes, I think this interest is just going to increase from the FI side.
Interesting observations. There are FIs out there who you haven't even heard names of. That's interesting, Pankaj. You've been around for so long. But I want to understand from you, how are you approaching some specific areas? Like, yesterday the commentary from REC was, they want to turn net NPA 0 in the next 2-3 years. NTPC has, surged to almost a 14-15 year high. There is huge interest in QIP offerings or block offerings from some of these renewable guys, Suznol and Inoxes of the world. Which part of the power value chain are you finding most value in right now? Because many have run up, some haven't in the same proportion. Where should the new investor, look for value in this entire power value chain?
I think if you look at the entire power sector, I think it's a very strong thesis for the next 3-4 years. And let's look at some of the data points. The power demand continues to rise at a very scorching pace. And clearly we have seen that peak demand numbers being, broken out. And the latest data again points towards that. So demand continues to be extremely strong. Now look at the supply side. The additions are mainly happening on renewable side, and incrementally very few thermal plants are coming on stream. And renewables come with its own challenges. We don't have a battery storage environment or ecosystem today. We don't have a transmission which is more agile towards renewable. So there are those challenges, and that's clearly reflected in the daily price of power. If you look at in the afternoon today, if you look at the IEX numbers, the power cost is at 2.5 rupees. But after 4:35 p.m., when there is peak demand in India, the power cost has started rising to 10 rupees. So that clearly shows that the timing is a mismatch right now. And clearly we don't have storage. We don't have that agility on the transmission side. And we believe that this would create problems from a power sector perspective, and merchant power will become a very important tool in the hands of generators. So the entire power value chain should do well, whether it be transmission guys, whether it be the generation guys, whether it be the guys who are doing the EPC projects. And we incrementally are quite positive on this space, just considering the demand and supply. India cannot afford to have no thermal power generation. Incrementally, I think we will need to also plan the thermal power generation as you move ahead.
Right. You know, Pankaj, interestingly, you were talking about opportunities within pharma and IT as well. Now, many think or rather consider IT still as an untouchable area, and, you know, many question marks on whether or not this is going to be a slow grind story, at least for the service providers, and whether the ones like a Persistent or a Map My India, you know, special situation, quasi-AI plays are the ones which are going to deliver better from here onwards. Wanted to understand your thoughts on where within IT should one be hunting, because I guess IT can't be an across-the-board play now. You've got to be very selective.
You know, I have heard this argument time and again that Indian IT services are a write-off. I still remember 2008-9 when there was global financial crisis, banks were under pressure, and everybody said that Indian IT services, which depend on US banking to a larger extent, probably will have a tough time. Many will go bankrupt, and probably the best of the IT sector phase is behind us. From there, we have moved a long way, and today IT services exports are about $170–180 billion. Don't forget that whenever there are cost pressures, when there are cost takeouts, people would like to outsource, and Indian IT services clearly benefit out of it. And cloud adoption, which is a slightly medium to longer term theme, globally it's still at 30%. There's a long way to go on the cloud adoption side, and Indian IT services are playing a very important role in the implementation of the cloud servicing. Having said that, I think what I have said that in the near term, there seems to be pressure on earnings led by delay in some projects by the large MNCs. Also the fact that you have seen discretionary spend cuts. So people are spending where it is needed the most rather than spending on the discretionary projects. So that leading to some slowdown in the Indian IT services. But I think it's more transitory in nature. Maybe 2 quarters or more of earnings downgrade cycle. But I think FY25 starts to look promising again. You have seen the deal win announcement by large IT companies, multi-year billion-dollar deals. Playbook is it's there. And I think FY25, when I look at the order inflow today, I think that gives us a confidence that the earnings growth or the revenue growth for the sector could be much better than FY24. So over the next 6 months, I think it will be the time to selectively start picking up stocks in the sector and probably move more towards equal weight at the sector level rather than underweight.
All right, Pankaj, good to have you on board. Thanks very much for sharing with us your rationale on the market. So yes, it continues to remain a bit cautious when it comes to the mid and the small caps, and talking about how, yes, this is a stock pickers market. Just a quick check-in as to what the index is up to at the current level. Well, now, precious little really, given the fact that we are sub the 19,300 mark in trade today. Pressure coming in from all quarters. IT in particular is a weak link. TCS, Wipro, as well as Infi, HCL Technologies and Tech Mahindra all down and out in trade today. Bajaj Auto, SBI Life, as well as Reliance Industries not doing much on the upside. Let's connect with then Mr. Pradeep Kumar Kheruka, who is the Executive Chairman at Borosil Renewables, to talk a little bit about the outlook in the solar segment and their focus on exports and business. Thanks so much for taking time out. Now, I want to begin with getting your views on the news that the global company Maxion cut the guidance citing weak demand for solar products. I wanted to understand from your perspective, are you also seeing any demand challenges?
To answer that question, no, I don't see any decline in demand at all in India, especially in India. The thing is that the government has a very strong objective of solarizing the nation, and they have very aggressive targets. More important than having an aggressive target, they're putting out tenders, which they are vigorously trying to sell, in the sense that they're trying to install the power. And I see no let up or no delay from the government side in solarization in India at all.
Right. I also wanted to understand about the pricing pressure owing to China dumping. We believe that you are, in touch with the government as well to reinforce ADD. Do you foresee that the decision can be taken sooner, or you do not see any profitability, pressure coming into?
There's no question about dumping. I want to illustrate to you the extent of Chinese dumping and why the Chinese government is directly involved in this. You see, we just got a half-yearly earnings report from perhaps Europe's most famous module manufacturer called Meyer Burger. It's a Swiss company with production in Germany. In their report, they state that in the year 2022, 85 gigawatts worth of solar modules were imported into Europe and 40 gigawatts were installed. In other words, 45 gigawatts are lying in warehouses. Now, in the current year, they're continuing to import, the Chinese are continuing to ship solar modules into the US, into the European Union. And despite the fact that that kind of quantity is lying in the warehouses. Now, we are talking of billions of dollars here. And no private module manufacturer can dream of having the kind of financial resources which are required to dump this kind of material, physically dump it, and leave it in the warehouses. So we need to understand that this is a game being played by the government of China. This is not an individual producer of glass or modules or cells or any of the other components which go into the production of a solar module.
Mr. Kheruka, your point is well noted that it's a government with intervention which is causing this kind of moves. But for India, the Indian demand for solar glass remains strong. What about the export part? It comprises around 30% of your turnover. Is exports getting crowded because of China's foul play?
You see, it's a market which is changing every day. All right. So we are exporting to more than one geography. And there remains, okay, so in the export market also, there is a segment called rooftop solar. Rooftop solar is very, very popular in Europe. The common public puts solar modules on the rooftops and on tops of the warehouses and so on. And here, the demand is for quality. So these modules invariably come from European module manufacturers. The European module manufacturers invariably choose glass from Borosil, or they choose glass from the German producer called GMB, which is also owned 86% by Borosil. So fundamentally, it becomes a Borosil glass, solar glass, which goes on to a module which is made in Europe. And this demand remains intact. We must remember that we only make 650 tons of saleable glass every day. And about 30% of that is something which we're still able to continue to sell. So nobody can predict the future. But as of now, that market is intact.
Sure. What about inputs like natural gas, soda ash? Those prices have been softening. So does that translate into a margin recovery for you anytime soon?
Well, you know that there are other costs which keep rising, like, for example, wages. So yes, it's a fact that soda ash prices have softened, as have prices of natural gas. And we are waiting to see how the future unfolds. If the future unfolds in a positive way, in the sense of lower prices for inputs, that's certainly going to help us to meet the challenges on margin. But in an overall scenario, I would say that perhaps for this quarter, the margins remain a little bit under pressure.
Mr. Kheruka, well, we know that you do not give guidance in specific, but overall, if you could give some color on how rest of the 24 could actually pan out for you, are you expecting it to be relatively weaker to the last year, or you are witnessing improvement in business already?
You see, we read a lot of reports which are published internationally. And these reports are now saying that there would be a squeeze, which they are foreseeing in the last quarter of this calendar year, which means between October and December, a squeeze is foreseen in solar glass. And if that squeeze emerges, then prices will firm up. And we are in a volume game. So, a little bit of firming of prices improves margins, a little bit of decline in prices hurts margins. So it's anybody's guess. The main thing with my experience in industry is that demand must remain robust. And generally, things are on keel. We are under pressure. There's no question about that. And we do require government support urgently, without any delay, in removing those, withdrawing those circulars which are exempting imports of solar components from basic customs duty. And I must stress here something, that the duty on glass is about 15%, all right? And the cost of glass in a module is 8%. So we are really talking about 1.2% extra that the module manufacturer would have to pay for his glass in case the duty is imposed, which is not so much. So it really should not make a big dent in their profitability. However, obviously everybody is chasing his own profitability.
Yes, they are. Mr. Kheruka, lastly, wanted to understand that a lot of players are coming up with new capacities, right? So is that the local competition has started picking up in the market, and how would it impact you?
Now, I must tell you, all the glass furnaces have started producing, each one of them. So today, instead of one manufacturer in India, there are 4. That's the matter of fact. So far as the question of sales is concerned, I think they are stabilizing on their production. It takes time. It took us about a year to stabilize. I hope that they can do it earlier, but it's going to take time. And after they have made the glass, they have to give it to the module manufacturer, who has to certify it himself. After he has done it, he has to send it for certification to the relevant electricity authority in the nation. And then they certify the glass, and then he's supposed to be able to use it. So it's not happening overnight. It's going to take a little time, but of course they're going to come. They are serious people. They have been making glass for the last 40 years, in some cases 50 years. So they know how to make glass, and I'm sure they'll come. But I do not see that their entry will disturb us in the slightest way.
All right, appreciate your time. Thank you so much for joining in and giving us a view as to how things are shaping up and how business is looking. All right, just a quick check-in on Concord Biotech. The pre-open indicative price is indicating that it could be at a decent premium of close to 22% to the issue price. And do remember that it was expected to be a fairly decent listing for a Concord Biotech as well. And currently looking at about 900. Let's move right on, though, and focus in on Parle products. Talk a little bit about the inflation impact. Is that going to be a bit of a concern? What's the outlook when it comes to demand and competition? Mayank Shah is the senior category head at Parle Products and now joins us live on the show. Thanks so much for taking time out. I want to begin by addressing the fact that wheat prices are at a 6-month high. Do you think that this is a bit of a worry for the company, and how are you looking to alleviate concerns on the high wheat price front?
Yeah, so wheat prices are definitely a little bit of concern, especially, if you look at the run-up of prices in last 1.5 months, there's an increase of almost about 7 to 8% in wheat prices. As a result of which, there's a bit of pressure on the bottom line. However, the other key ingredient, which is edible oil, is down compared to last year, which is a saving grace. So net, the impact is not as much as one would expect, because wheat happens to be a key ingredient. But it should not move further up from here, is what our concern is. And we are pretty hopeful about it, given that the crop was good, although government was not able to mop up, for their through FCI, the quantum of wheat that they wanted. But we expect that, given the measures that government has taken off late in terms of hoarding of wheat and stuff like that, wheat would be freely available, and the prices would be relatively stable. They may not, shoot up any further. So that's our outlook on wheat is concerned. And as far as margins are concerned, currently that's not as much a concern. But yeah, it would be a concern if wheat prices continue to rise.
But in that eventuality, Mayank, what is the company's strategy if wheat prices continue to hold out or escalate from the current levels as well? Do you pass it on to the consumers? And have you already done that?
Yeah, so if you look at inflation scenario last year, I think it was a major challenge last year, and inflation was unprecedented as far as certain inputs for food items were concerned, especially edible oil. And given that, I think most companies had taken price correctives last year. However, if you look at the major ingredient which had gone up last year, which was edible oil, that has cooled down. It has come down from all-time high of about 175 rupees to 95, 98 rupees today. And as a result of which, I think there is a much needed respite. And most companies have passed it back. In fact, almost all companies have passed back that savings to consumers through either consumer offers or reduction in MRP. If they are bigger packs, it's through reduction in MRPs. If they are smaller packs, in terms of consumer promotions by giving a little extra weight free to consumers. So they've passed it back. There might be a bit of rationalization that might happen, if we continue seeing a rise in wheat prices.
Mayank, I want to understand how is your distribution, across the country reacting, or even the demand. I want to gauge your business partners across the country and even your target audience. How are they on the demand front? If you indeed go ahead and hike the prices even mildly, would there be acceptance or it's a pushback there?
It should not be, because what happened last year was when we increased the prices, yes, volumes did get affected, and I think one of the major reasons why most companies are passing back the reduction in input cost is to gain back volumes. While value growth is coming, the biggest challenge ahead of most companies, as we all know, in last quarter has been volume growth. So volume has not been growing. The growth that's coming is primarily driven by increase in prices. Volume growth is either flat or at most just 1 or 2%, not more than that. And just to get the volume growth back, I think companies are passing back. So there has been some sort of resistance, as you rightly said, in terms of increase in prices. But just to mitigate that, companies are passing back the reduction in input cost to consumers to drive volumes. Now, if we reduce that freebie or promotion that's being given or passback that's currently given to consumers, there might be a little bit of impact on volumes. But then we need to understand it's always a relative. So, biscuits don't operate in isolation. They operate as a part of, a larger snacking assortment. So, if the impact of input cost increases across the board, across multiple segments of food or processed food or snacks, then I think, the impact would be marginal. But let's say, in case of wheat, which becomes primary or key input in biscuits, not so much into namkeens and other things, if that's only going up, and if biscuits are the only category which are taking a price hike or reducing the passback that they are giving right now, there might be a little bit of impact on volumes.
Mike, before I let you go, just wanted to understand the consumer pattern and behavior as well in these times of escalated food inflation, if you will. I mean, is it more the mass or the premium biscuits which are finding favor, or, smaller packs, for instance, which accounts for around 50% of your overall sales? Are consumers then shifting to those?
Yeah, so both of them, in fact. So, a good thing right now is that the volume, we are getting back the volume growth because of passing on the benefit of lower input cost through extra weight and reduction in MRP. Urban India was doing very well. It has been doing well since last almost about 7-8 quarters. And if you look at rural India has started, gaining traction in last 1 quarter. So there is a revival of demand that's happening in rural India, and it's further aided by the additional passback that companies are offering because of the reduction in input cost. So currently, both of them are growing, and since both geographies, as in urban as well as rural, are growing, both value product as well as premium products are doing well. Till about a quarter back, premium products were doing well, and there was a pressure on value products. But now, as we currently speak, because there is a revival of demand that we are seeing in the rural, we are seeing traction across both premium as well as value offerings.
Good to have you on board. Thanks so much, Mayank, for giving us that perspective with respect to how business is shaping up. So yes, there is a bit of pressure on the bottom line on account of the increase in wheat prices, but that will be offset with palm oil prices dropping. From one corporate voice to another, then Blue Star in the spotlight on the earnings fine print. B. Thiagarajan is the managing director, now joining in. Good to have you on board. To start off with, demand trends have been subdued in Q1. Just wondering what exactly is the growth rate that you're expecting for FY24? Do you think that we will continue to see a little bit of a subdued trend?
Good morning. It's a pleasure interacting with you. Yes, the summer season was disappointing, basically due to unseasonal rains across the country. Having said that, some point of a time, even your channel had said that it may end up with a marginal growth. It did end with a marginal growth. The industry would have still de-grown is my estimate, but we grew by around 5 to 6% in Q1. It is a quarter in which one should have witnessed at least 20% growth. That's how we had began the financial year. But having said that, I still hold the view that FY24 as a whole will end with at least 10% growth. Even 15% is possible. Because whenever summer season has disappointed, rest of the year, the demand continues to be good. This is, I'm talking about room air conditioners.
Mr. Thiagarajan, your entire industry also has seen very aggressive competition and eating into market share by players and all of that. You and one more of your peer have been, the largest shareholders so far, but now new entrants are also taking in a lot of market share, trying to take back some of the market share. How are you facing that? What is your market share stand right now, and what's the strategy?
So whenever there is going to be growth, the competition is inevitable, right? So the penetration levels in room air conditioners are just 7%, and it is likely to reach 10% very soon, within a couple of years, and it will indeed be growing in an exponential way over the next 5 years. That is our estimate. Now, when that is the kind of growth, you can anticipate the competition to be intense. You are also aware, due to the PLI scheme, huge amount of manufacturing capacity expansion investments are taking place. So within 18 months, you will see manufacturing capacity doubling. So you can see competition being intense, margins under pressure. But we have learned to live with that. If you are playing in this game, you should be prepared for that kind of competition. So as far as we are concerned, every year we have grown the market share from 2011 onwards. That's the time Blue Star entered the residential segment. And our goal is by FY25 to reach a market share of 15%. Today it is around 13.5%. So the strategy, we have to develop products for the affordable segment. The bottom of the pyramid, you should be able to address, because the growth is from first-time buyers. 95% of the sales is happening with the first-time buyers, and it is from aspirational middle class. 65% of the market is in tier 2, 3, 4 towns. So we would like to keep offering products that are affordable. We entered that segment only last year. We would like to expand our distribution footprint in North, where we have not been that strong as the rest of India. We would like to make our brand relevant. That's why we have Virat Kohli as our brand ambassador. We are increasing our advertising spends. Last one is that how you will be able to differentiate yourselves in terms of after-sales service. So Blue Star is known for its after-sales service. We would like to differentiate ourselves there. Having said this, the margins are going to be under pressure. That's why a couple of years ago, I would have stated that the EBIT margin of something like 10% is possible. We are now saying it will be somewhere around the 8.5% to 9%. That is taking into account even the PLI benefit one will earn.
Okay, that's that on your FY24 guidance. But Mr. Tyagarajan also wanted to understand whether the consumer is downscaling or are they price insensitive right now?
See, in certain categories, you are reading that premium products are being sought and the sales is going up. But as far as room air conditioners are concerned, the reference point is even the star rating. The 5-star air conditioners are less than 30% of the sales in the industry. So therefore, it is 2-star, 3-star air conditioners dominant market, number one. Number two is, since they are first-time buyers, they would like to go in for products that are functionally superior but at affordable prices. So the preference has been very clear. That's the reason why Blue Star entered that segment as well. If I have to grow the market share, I have to address that segment.
Okay, appreciate your time. Thanks so much for joining in and giving us a view on how things are shaping up at Blue Star. So that's the management alluding to the fact that yes, FY24 growth will be at about 10 to 15% for RACs, and they have managed to grow despite the fact that it has been a bit of a disappointing summer. All right, the listing of the day then, and it's Concord Biotech that is in the spotlight, and no surprises then to see that it is at a fairly decent premium to what the issue price was indicating. So given the fact that you do have the stock that is listing at about 904, that's where it's currently at. Do remember that it was expected to be a fairly decent debut given the fact that there had been strong response from investors in the primary markets as well, but there was a bit of a concern with whether or not it would see that replicated in the secondary markets, but just about a 22% premium thereabouts is where the stock has listed at. All right, let's move right on then. And it's been a mixed show when it comes to GE Shipping. What is the outlook when it comes to the top line growth as well as the order book? We've got Shivakumar G. He's the CFO and Executive Director at GE Shipping. Many thanks for joining us on the show. Now, your shipping revenues days this quarter is down about 4% sequentially. Can you give us more clarity as to what exactly happened and what we should expect for the second quarter?
So the days are down. Good morning and thanks for having me. The days are down because we sold 2 tankers last year, one crude tanker and one LPG ship. And that's why our fleet came down in Q1 versus Q1 of the previous year. So that's on the capacity itself. Tanker markets were stronger this year versus the previous year, the corresponding quarter. Bulk carrier markets were weaker. They more or less compensated each other. And we got a benefit because the rupee depreciated versus a year ago levels on average. So the capacity is down from a year ago. After the end of the quarter, we've also sold one more crude tanker, our oldest crude tanker. So to that extent, we'll have another drop in the number of days, operating days.
Okay, fair enough. Now, your NAV has gone up in line with your profits. Was there a change in the overall fleet value in shipping? Can you give us a sense of your crude and gas carrier bulkers, the product tankers, etc.?
Yes, the NAV has remained, as you rightly pointed out, gone up in line with the profits. The overall fleet value hasn't changed by more than 0.5% in dollar terms. And of course, the exchange rate hasn't changed much between March and June end. Tankers went up slightly in value, the crude tankers and the LPG ships. Bulk carriers came down slightly in value, and so they compensated for each other's moves in effect. And that's why the NAV just moved up to the extent of the profits for the quarter.
Right. I also wanted to understand, Mr. Shivakumar, about, TCYs, because from the very high levels of Q4, you've come off a little bit for the tankers. The LPG carriers, of course, continue to be on time charter. And dry bulk was, as we understand, at very weak levels in the fourth quarter, FY23 that is. There has been a weakness in dry bulk for a while now. When do you see a reversal, and what's the projection for tankers?
Yeah, good questions. So in tankers, let's address the tankers first. Typically the summer months, so that's Q2 and Q3 of the calendar year, which is Q1 and Q2 of the financial year, tend to be weaker for the tankers, for the tanker markets. The summer months are when refinery maintenance happens. Refineries go into maintenance, and therefore the demand for crude is less. They're producing less of refined products, so there's less refined products to transport. So the strong period is between October and March. So that's for tankers. So we are going through a bit of a seasonal lull for tankers, which is to be expected. For dry bulk, it's the opposite. The weakest quarter is traditionally the Jan to March quarter, which is Q4 of the financial year. It usually starts to recover as we get into the summer. So we had a very weak Jan to March quarter for dry bulk, which recovered slightly in Q2. That's in April to June. After that, it's been a little subdued. There was a little excitement at the start of the year around the China reopening and how that could affect dry bulk and those kind of things. But China has reopened. Coal imports have gone up because they're having a hydropower problem due to a bit of a drought condition. Iron ore imports have also gone up in this year over the previous year. However, it still hasn't helped to really boost the dry bulk market as was being hoped in some quarters. So the trigger for a possible... today, the markets are a little stronger for dry bulk, but that's happening because of disruptions. The Panama Canal area is also suffering from drought, so passages are restricted. So there is congestion building up at the Panama Canal for bulk carriers, for Panamax bulk carriers. And that's causing an artificial shortage of Panamax bulk carriers, which means that the rates have gone up in recent days. On the demand side, I think the only thing that can really boost dry bulk is a big stimulus from China, because China is the largest importer of dry bulk commodities, and it is the big swing factor. So we'll see if that plays out, and that's anybody's guess, really.
Do you sense, though, that the China recovery is headed southwards? At least that is what all the data points seem to be suggesting. Everything from the interest rate cut to all these property players now filing for bankruptcy.
Yeah, it's not seen in coal and iron ore flows, really, because, as I said, we've had growth year on year. Of course, last year was a slightly low year because of COVID. But still, we've had pretty strong growth. Again, as I said, the coal import growth is not because of higher demand, but because the alternate is unable to produce the coal. So hydropower generation has been poor, and that's why they're having to substitute with coal-fired power generation. So demand isn't very strong, but still iron ore imports have been decent. But you need a significant stimulus, I suspect, for this to really take off.
Okay, and tell us a little bit about your offshore business, what the change has been in the market value of the offshore assets contributed?
Yeah, so not much change in the market value of offshore assets. It's not a very liquid market, so you don't get significant changes that way. But I think the values are around where they were maybe 6 months ago. The business is looking significantly better because of where oil and gas exploration activity is. It's picking up significantly, especially in the Middle East. So markets are picking up as and when assets come off their earlier contracts, which were at lower value, and are ready to be repriced based on current values. The pricing is going up, which means the realizations are going up. Again, this will take time to feed through in the results because we have quite a few contracts. But within the next 2.5 years, all of our assets will be repriced, including all the rigs and all the offshore supply vessels.
All right. Thank you so much for joining us and sharing with us that outlook on the company's business plans. We'll take a very short break right here on the show. Stay with us as we continue on the other side with Chartbuster Ideas, 19,268 on the Nifty.